Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, help to make it actionable, understandable, and clear. What a week, and therefore what a show. 3 important articles. The first being, are we due for a correction? It's a Morningstar article with excellent data that makes me think twice as to whether we will see a correction. We then look at a Jason Zweig article, one of our favorites. Smart money, dumb money, it's all just money. He talks about how these institutional investors and individual investors, not so different. And then we end with a gentleman named Michael Kitces. He is an advisor to financial advisors. He's a thought leader in the space, and he talks about why you would have a human advisor in the age of AI. Something I've been thinking about lately. At the top, we've got great data. This is Jeffrey Tack. He's a CFA, Morningstar. Talks about the duration of stock market expansions. And it also looks through, hey, gee whiz, when the market goes down, how long does it take? When it recovers, how long does it take? When it expands, how long does it take? I learned reading this article, my instincts aren't that great. I kind of thought I would have a pretty good idea of how long the typical recovery takes. And so just think about it. Do the thought exercise I did. Okay, typical stock market recovery, meaning the stock market is coming back from its low, and the stock market, and well, how about this? Scrap that one. Let's just focus on expansion. How long does the market go up? That's a simpler way of framing this. How long does the stock market go up typically when it just keeps going and going and going? They call a drawdown of something as 20% more, 20% or more as the stock market going down. That's a drawdown. So an expansion, you think, okay, well, how long do those typically last? Or you don't have one of these big drawdowns. Well, here's the data. There have been 11 expansions since 1926. The average expansion prior to this one lasted 69 months. The median is 56 months. So, over 5 years. The longest expansion, this was amazing. It was more than a dozen years, November of 1949 to December of 1961. The shortest was 12 months, November 2006 to October 2007. The market more than tripled its value in the average expansion. I'll say that again. The market more than tripled its value in the average expansion. 224% average cumulative return with a 20.8% annual return. So I oftentimes have this thought, and I know my clients have this thought because we talk about it all the time. Are we due for a correction? Is it time? Are we long in the tooth here? What's the current expansion we're under? Where are we? Well, as of December 2025, it was only in its 25th month. That's less than half the norm. And when people say, oh, the stock market's overheated. It's hot, don't touch. Well, guess what? The market's 21.4% return over that 25-month span is kind of in line with historical data. That I was wrong when I was thinking, okay, how long? Expansions aren't that long, maybe 3 or 4 years. But here we are. So if we look at this current bull market from the low of the prior decline, September 2022, it's risen around 93% off that low for a 22.5% per year annual gain. Only slightly higher than the 20.6% average annual return of prior periods. That data made me it further solidified the idea of do not try to time the market, listener. Don't try to pretend the market is overheated. You ride it out. This article goes on, and people say, hey, look, the stock market's about to, it's coming down now. It's had a good run. It's coming down. Like it's in laws of physics. It's been more than 3 years, this article explains, since the market last troughed in September 2022. Does that seem like a long time to you? Are we on too long of an upturn here? Well, since 1926, it's taken the market 37 months on average to recoup the losses from a prior decline, again defined as a drawdown of 20% or more from a prior high. Quickest recovery was 4 months, snapback from COVID in 2020, the longest more than 12 years. That's the post-depression journey. The average expansion, 69 months. So we're just smack dab in the middle. Our current U.S. stock market, not too hot, not too cold, seems like a Goldilocks based on historic data. And it just further ingrains this thought that our instincts are not our friend. That gut you have, that gut feeling on where the market's going to go in the future, it's rarely informed by data. How do I know? Because I'm the same way. When I read data like this, I think, okay, got it. What is informing my gut then? Probably not great stuff. Maybe a little too much news. Not enough data. So distrust your gut. How's that? If I could summarize this article in one fell swoop, I'd say distrust your gut. Look back at data. Be willing to let the data push you a little bit. Because I think what it'll do is it'll tell you to do what the great Jack Bogle told us to do, which is do not look at your statements, do not look at your accounts. If the market is going up and up and up and up, and you're in year 5, you're in year 3, you're in year 2, do not think that it's long in the tooth. You have no idea where it is, and neither do I. Neither do I. But if you were to benchmark it, our current expansion, you're about halfway through it. About halfway through it. But so we think. You could be a third of the way through it. You could be a quarter of the way through it. There's, even now, as war is raging and oil's at 95, and goodness, foreign stocks, my foreign stock fans, it hurt, didn't it? This past month, you're down 5.4%. Over the past week, you're flat. But it feels like it was bad, doesn't it? You're down about 5.4% VXUS, the ticker, in the last month. And part of that's because the market thinks these international stocks will need oil. They're not going to be able to get oil. It'll be a problem. Over the last week, though, you're good. Over the last 3 months, you're good. Over the last 6 months, you're fine. It's these short-term blips. Can't get too excited about them. And then Jason Zweig, one of our favorites, headline, smart money, dumb money, it's all just money. Smart money, dumb money, it's all just money. He goes through and he highlights how the financial news media, even his own beloved Wall Street Journal, who he writes for, oftentimes says things like this. He quotes, individual investors are simply more prone to sell out when an asset class underperforms expectations. He then talks about Blue Owl's trouble. It's heavy marketing of funds to individual investors who tend to be flightier. You see that narrative that, it's the institutions who are really rock solid. It's the individuals who are flighty, like lightning bugs here, there, and yonder. Zweig says, nope, give me a break. He has sense. Of course individual investors make mistakes. Of course they chase hot returns. Of course they do. They're just like institutional investors. Robert Shiller, in 1989, is a Nobel Prize-winning economist at Yale University, who I'm told is a fine place to go to school if you don't get into your first choice. Yale University, they published a survey of individual and professional investors. And they're effectively asking, how much research do y'all do before you buy a stock? Well, the question they said is, was there a systemic search over a large number of stocks with certain characteristics when you got interested in a certain hot stock? So basically, how much research are you really doing is the question to institutions and individuals. And they're saying, hey, are you actually just picking hot stocks because you hear a name and your buddies said it at the water cooler, or are you doing your own research? It actually turned out that the institutional investors were more prone than the individual investor to take the hot stock and not do their research. Bizarre, isn't it? We had these assumptions. I oftentimes think of the Wizard of Oz at these moments. You look behind the curtain, it's just a little man with levers and smoke and an amplifier for his voice. It's not so different with these institutional investors. They were less likely to conduct systematic research than just the regular Joe. Moreover, March 2000, institutional investors, this is a quote, institutional investors quickly pulled capital out of the market while individual investors continued to buy. That's a study concluded by the Journal of Finance in 2011. This journal says institutional investors drove the run-up of individual technology stocks. Individuals purchased large amounts following individual stock peaks and during the year following the market peak in March of 2000. They also say institutions, not individuals, institutions significantly contribute to amplifying the 2020 COVID stock market crash with a significant and largely indiscriminate withdrawal of capital. This is a study published last year in the journal Management Science. Individual investors, they say, took the opposite side of these institutional trades and appeared to have fueled the stock market rally in the recovery period. What? What? I would have thought at least they tied. To see these institutional investors fail. And now here's the deal, listener. Because when you give your money over and you pay large sums to do it, you're engaged in that transaction because you have confidence that the men in suits with ties and degrees on the wall will do better than little fuddy-duddy you and me. Remember, we're supposed to be flighty. The institution's supposed to be tough. Nope. Don't believe it. Follow the data. This kind of goes back to that expansion, stock market expansion data. These expansions take forever. You wouldn't know it unless you saw the data. My gut would have said, maybe every 2-3 years, 4 years, you get a 20% correction. Yep. And in the same vein, my gut tells me, yeah, you know what? These institutional investors are going to be better than just a guy at his computer. Nope. Wrong again. Wrong again. This article says, no matter how much you have to invest, you're still human, with all the imperfections and inconsistencies of the human mind. Recognizing your fallibility and limitations, as Warren Buffett and the late Charlie Munger have said repeatedly, is what makes good investors great. Preach. Preach. The quote I like to use is, dumb money ceases to be dumb when it recognizes its limitations. It's no longer dumb. And the application of that is that people buy index funds. You're no longer hopping and jumping around, chasing stocks, or what's just as bad as chasing managers who are chasing stocks. Sometimes it feels like the movie Inception. You're chasing managers who are chasing stocks. That's a legitimate business. Managers choosing managers that choose stocks, which is another way of just choosing managers. You're choosing CEOs. By the way, you're at the very end of that feed line, getting little bitty crumbs that come out. Little bitty crumbs. I recommend you go direct. Don't choose any managers. Don't have intermediaries unless you must have them. Or if you do have an intermediary, as that's what Vanguard is, that's what these index ETFs are, let them be priced at cost with no margin. And in many instances, these products are free. Perhaps you've heard about my annual report escapades with these exchange-traded funds. I've not tried AI with this, but I should. But it is the case that many of these exchange-traded funds at Vanguard, in particular, engage in securities lending practices at the fund level. So when you see that expense ratio that the SEC requires they list a certain way, and it says 0.05 or 0.07 or 0.03, at Vanguard, it might be negative 0.02, 0.05, 0.03. Because at Vanguard, when you do securities lending, those profits are remitted to the fund holder. Every other company remits them to the parent company because they got shareholders to please. At Vanguard, you are the shareholders. So believe it or else, even those quoted expense ratios, in some instances, and you don't know until you read the annual report, in some instances, they have paid you for the year to use their product. They are paying you for them to be your intermediary. That is a smart way to invest. Very, very, very smart. And in closing, Mr. Michael Kitces, who's a thought leader in the financial advisor space, he had an email he sends out to advisors. He asks he states this. He says, why clients hire human advisors in the age of AI. How advisors can positively influence clients' emotional states. I've been thinking about this as AI has gotten better and better and better and better. Kitses's letter explains, technology presents a dual-edged sword for financial advisors. On the one hand, technology can make the advisor's job easier by expediting or outright automating many of the tasks that advisors do for their clients. Robert Hunt says, agreed. But on the other hand, that technology can also make it easier for clients to manage their finances on their own, raising the bar for the value that human advisors must provide to make it worthwhile for clients to hire them in the face of less expensive do-it-yourself alternatives. So there we have it. There's a conundrum, listener. If you're a financial advisor, hey, great. You have all these tools that you can use to help you do things quickly that used to take a long time. I'll have my Gemini open in a meeting, on a call. Client asks a question, doesn't think I can get back fast, and I'm getting the answer as we talk. Putting together whatever they need, quick. Evaluating an investment. There's a real estate deal I evaluated this week where Gemini helped me summarize. I reviewed it, looked at it, and then Gemini, hey, summarize the cost structure of this private deal, help make understandable compared to the boom. Knocked it out for me, really sped up my process and built out a pretty little visual for the client. Well, that's good. That's good. Good for the client, good for me. I can turn things around faster. All good. So are people not going to need people anymore, though? Over time, will the clients not need advisors? I think some may elect to just use, and the AI will only get better. So some will elect to just go that route, go all digital. I've not seen it yet in mass, but I think many will do that. It'll be effectively free. What's the dark side of that? As I see it, it pushing against the model. Who's going to stop the model if it does something incorrect? Maybe we get to the point where we don't think it can mess up. I think we're a ways from that. But then who's going to help you make sure it happens? It's a bit like a personal trainer. Who's going to make you do that last rep, that last set? Who's going to make you do that conversion of your IRA? Who's going to make you sell that individual security that you should have sold 10 years ago, but your granddad gave it to you? There are some unique challenges in the financial advice space where many times as a human, I am seeking to creatively find ways to let clients do what's in their best interest. It's not always easy. It's my view that humans will have a role in that for the foreseeable future. But I'd tell you, I'd be using AI if I were you. Just try it out, ask it questions. A lot of clients will come in with the AI readout already. They're ready to go. They've already talked to ChatGPT before me. They're getting a second opinion. I think there's wisdom in that. But amidst our technological age, the main thing will still be the main thing. It's to keep your costs low, your investing simple, and your time horizon long, because that is going to give you a shot on your investing journey. Until next time.